SIGA's ninth report on the performance of state-owned enterprises and listed entities owned by the state is just depressing. Okay, I've taken my blood pressure medicine, so I'm ready for Kujako Boateng's breakdown of this report. If I were you, I'd grab onto something because some of these details will surprise you. Could you first of all walk us through what you've been learning, and then we'll bring in Professor Godfred Bokpin and Yaw Appiah Lartey to have a discussion about it.
This report is quite lengthy, about 400 pages of information, and I think we should commend the State Interest and Governance Authority. They've done this consistently since 2017. And every year you see an improvement in the report, the number of entities they are covering and the detail that they are sharing. We have advocated for ministries, departments and agencies to publish annual reports consistently. We've advocated for state-owned entities to publish their annual reports and make them public consistently. And at least if the ministries are not publishing on the state-owned entities bit, we are getting some information based on the work that SIGA has done, and it is good. If you look at the reports, if you look at the numbers, the outcomes, it looks like there have been some improvement here and there, and SIGA is also being very, very concerned about how our state-owned enterprises are doing. Now, one interesting page I've been looking at is page 25, page 26, those two pages, because that's where the profit before interest and tax is captured. And I think it gives us a lot of information and insight into how our state-owned enterprises are doing. So I'll share some details from that page for you. But let me give you a general summary of the work SIGA has done. If you look at the work they've done, this is the 9th edition. It covers 150 out of the 175 state enterprises, so 85% coverage. 52 state-owned enterprises, 30 joint venture companies, and 68 other state entities. And this year they added 3 new entities. That's the Minerals Development Fund, the Nuclear Power Ghana Limited, and National Biosafety Authority. And nuclear power is one institution we should also talk about one of these days. Yes, it's been there for a while. We need to know where they are. At least the VRAs are doing hydro and thermal. We have making some investments in also hydro and solar. Are we going to go nuclear as a country? Are we going to generate electricity from nuclear as a country? When do we intend to do that? What investments are we making? What investments have we made so far, and what are the outcomes? So that entity, Nuclear Power Ghana Limited, is one we need to talk to one of these days here on the show. And then there's also the National Biosafety Authority we need to talk about. Now, if you look at the financial statement quality challenges as reported by SIGA, only 34.87% of the accounts were fully audited financial statements. That is 53 out of 152. 13% were audit drafts awaiting board sign-off due to governance transitions. We changed the government, boards are being reconstituted. Some agencies had their boards early, some of them didn't get their boards early. And then 51% are management accounts where audits were not completed. Now, if you look at the general performance insights, some entities are showing strong performance while others are struggling. If you look at the entities in the transport space, for example, transport and logistics, over the past 5 years, they've been posting profits. In the energy space, their growth has been consistent over the past 3 years. Communications, it's not that good. AT, investments in other telcos, I'll share that with you. Now, major problems, Winston mentioned that earlier this morning. The Bank of Ghana's negative equity, ECG and Ghana Water's mounting debts. COCOBOD is also facing debt and production issues. And these 4 institutions I've mentioned, if anything happens to them, something happens to Ghana. If Bank of Ghana is in crisis, we will feel it. If ECG is in crisis, we will feel it. Ghana Water, I have said before, that if in the next 5 years things continue as they are going, Galamsey is going on as is going, their losses are going as it's going, Ghana Water may have to be shut down. That's what I think. Okay. Now, SIGA wants us to really work on urgent reforms for most of these institutions. And now let's look at the numbers. Revenue growth general from 104 billion in 2023 to 133 billion. That's about 28.3%.
It's all in cedis, right?
In cedis, not in dollars. In cedis. We are not. So it's a cedi economy.
Everything is in cedis.
No dollar. Right. Because the dollar, Abochi is still in the system. Now the profits before interest and tax improved from 1.6 billion to 1.6 billion from 377 million. You know, earlier I said it looks scary, right? But if you look at it generally, there have been improvements. But then when you go institution by institution, you realize that we have systemic problems that we need to solve. And the 3-year turnaround story, massive loss of 9.6 billion in 2022. Now we are seeing some gains as we go along. So these are the general overview. So this is on the state-owned side, the state-owned enterprises, revenue growth 28%. Now when it comes to the joint venture companies, we are seeing a growth from a 1.3 billion Ghana cedi loss in 2023 to 1.5 billion Ghana cedi profits in 2024. So there's been improvement. And then if you look at the other state entities as well, their deficits are reducing. So if you look at it generally, it's good, right? But now when you go into some of the key institutions that are the foundations of our economy, you realize that there is a problem. If you go into the power sector, for example, if you look at the top 10 institutions with very high liabilities, you realize that a lot of them are power sector institutions. COCOBOD is also in there, so we'll run you through that. But let's look at the profit before interest and tax bits to get a general understanding of how our institutions are doing. Then we'll look at the various subsectors. Over the last 3 fiscal years, the SOE sector has shown gains in operational efficiency. This is from SIGA, Kojo, so it's good. They have shown gains in operational efficiency, okay, culminating in profits before interest and tax of 1.5 billion Ghana cedis from a recovery of 376 million in 2023. This is good. Now the energy subsector sustained its 3-year pattern of operational recovery, with losses narrowing to 4.3 billion in 2024 from 6.1 billion. So you see where it's going. So generally we are recovering, but there are still losses in there. And the losses are not as bad as last year's losses. Now, if you look at it in detail, it says that this can be attributed to a tremendous drop in ECG's profit before interest and tax in 2024, which is 6.9 billion from 10 billion in 2023. So as I said, some of the institutions, ECG, Bank of Ghana, COCOBOD, when they are suffering, their sectors suffer. So ECG's recovery is giving us some good outlook in the energy sector. Now the transport and logistics subsector continued its operational growth to a profit before interest and tax of 4 billion Ghana cedis in 2024 from 1.8 billion. So you see the growth in that particular space. It's been huge, and we can go deeper and look at the institutions in the transports and logistics subsector. Manufacturing also recorded an increment of 186%. Okay, that is the percentage. It looks big, but the actual figures are quite small. To 182 million Ghana cedis in 2024, primarily propelled by the strong performance of PMMC, which is now Gold Board, right? And if you look at the trajectory of Gold Board now, I want to project that 2025, the story will be different for manufacturing, because Gold Board is making a lot of gains, okay? And PMMC is now the Gold Board. Now, if you go to Winston's industry, Agric experienced a significant downturn from a profit before interest and tax of 5 billion in 2023 to 2 billion.
Agric,
Yes, state-owned enterprises in Agric. From 5 billion, profits dropped to 2 billion. Profit before interest and tax. It's something that we need to talk about. So we've been saying profit before interest and tax, and Winston is our guy. Winston, what are all these terms? Profit before interest and tax. What does it mean if you say a sector recorded profit before interest and tax of 2 billion?
Well, what it basically means, so you're looking at your earnings, so if you're looking at earnings or profit, if you can say earnings before interest, tax, or profit before interest, what it simply means is that how much, of the company's revenues, or how much of the company's profit before it pays its interest and taxes that it has to do. So it gives you an idea, because post the payment of these interest and taxes, the profit will reduce. If we go into say and this one says profit before, but if we go into say earnings before income, tax, depreciation, and amortization, it's basically telling you how efficiently a company operates and how much of its earnings are attributed to its operations. So for instance, what you're doing is that before you probably come into the payment of interest, before you come to the payment of taxes, before you engage in depreciation and amortization, what is the company's position? How much of its earnings are based on its operations in general? So that gives you a fair idea of how much it is of how well a company is doing. And mostly people would prefer to use this to actually identify whether a company is doing well or not. The other issue is that sometimes when it comes to the payment of taxes and all, there are other issues here and there that could come in. So for instance, a company can have a very huge positive figure when it comes to its EBITDA, earnings before income, tax, depreciation, and amortization. However, if say the company engaged in a capital allowance over a period, or let's make it in simple terms, depreciation over a period of an asset that the company is put back in its asset pool, the asset then be considered as say revenue. If that asset is considered as say revenue, then what it means is that the tax authorities would calculate that as part of its revenue and tax it. The company would not calculate that as part of its revenue. But for purposes of taxes, we could calculate that as part of its revenue, and that could only lead to a huge tax burden, which sometimes could lead to a loss for the company.
Now, based on your explanation, we'll be going for a break shortly. There is the communications subsector's loss before interest and tax. And that widened from 700 to 792 million in 2024 from 297 million. And it says this deterioration was largely driven by Airtel Tigo, whose loss before interest and tax increased sharply to 784 million Ghana cedis. When we come back, we will talk about the net profit after tax. And after that analysis is done, you realize that the state-owned enterprise sector maintained its unbroken 5-year run of losses. This is what Kojo is waiting to hear. 5-year run of losses at a consolidated net loss of 9.6 billion Ghana cedis. Why is this happening?
Talking about the SIGA report. It's the 9th annual report on the performance of state-owned enterprises, and it's not looking good. We have to talk about it. Professor Godfred Bokpin will join us alongside Yaw Appiah Lartey. I think Yaw is on the line right now. Yaw, good morning to you.
Yeah, good morning to you.
Thanks for making the time. Now, we're glad you're here. We need to talk about this. But just before we get into that, Kojo Akoto-Boateng was breaking down the report for us. Kojo, I'm interested. GIHOC, how did they do?
Before Kojo comes in with GIHOC, Professor Bokpin has also joined us on the phone. Prof, good morning. Thank you very much for joining us.
Yes, good morning. And good morning to our cherished listeners.
Great. Let's just share the GIHOC performance with you. Then we can get into the conversation. Kojo.
Now, according to the report, if you go to page 110, GIHOC's financial position remained weak between 2023 and 2024, with operating profit margin declining from 19.94% to 24.24%, and net profit margin declining from, in fact, it's negative 32.52% to negative 34.07%. Now, so GIHOC is also making losses, really.
Oh.
GIHOC is making losses.
President Mahama was surprised that a company that sells alcohol can lose money.
Yeah, but so if you look at their numbers, key figures for 2024, 85 million in operating revenue, 20 million in operating loss, 29 million in net loss. That is GIHOC.
Wow.
Okay, so
All right, let's get to it.
Thank you very much. Let me start off with you, Professor Bokpin. Even though many people know you as an economist, what they do not know is that you're an accountant too. So let's start with you before we get to Yaw Lartey. So now the state-owned enterprises posted a loss of 9.67 billion. And that's an increase from the 2023 figure of 7 billion. You've gone through the report, Professor Bokpin. Generally, what's your assessment of the performance of state-owned enterprises in 2024?
Well, thank you very much, Winston, and good morning to our cherished listeners once again, and to my senior friend, Yaw Appiah Lartey. Yes, it's more of the same. There's no incentive to do well and better. When I say, I'm looking at it from the incentive mechanism. Winston, this country has accepted this poor performance, and we reward it adequately. You know why I'm saying so?
Tell me.
There is a budgetary provision for state-owned enterprises in our national budgeting process, where annually an allocation is made to subsidize some of these state-owned enterprises from our tax revenue and all of that. In 2023, if you look at our national budget, you'll find that under the resource allocation framework, there is an item that we call other expenditure. This other expenditure covers energy sector levies and then transfers to meet energy sector shortfalls and other state-owned enterprises, just to keep them afloat to some extent, apart from the revenue they generate from their core activities. This is what we have done. Then we also find a way of passing on these inefficiencies to consumers through levies and other instruments that the state, using its power, inflict on the vulnerable citizens. You see what we call ESLA, right?
Yes.
If you look at what went into ESLA and the inefficiencies and how we sought to recover that sector, and even more recently, the one Ghana cedi levy on fuel, you remember, right?
Yeah.
So we are able to procure fuel and all of that to make sure that we have electricity and all of that. So if you look at the kind of incentive mechanism that we've put in place, really, there's very little motivation actually to do well, because there are no punishment linked to that. And then also, really, nobody gets sacked. If you lift the veil, you realize that some of these state-owned enterprises have become the medium through which politicians reward political financiers and patronage and all of that. And therefore, our ability to elicit performance, efficiency from them is weakened from that perspective. If you look at what we call other expenditure from the budget provision, in 2023, we allocated 23.7 billion Ghana cedis for that. In 2024, it went up to 27.7 billion Ghana cedis. Guess what? In 2025, we allocated 33.6 billion Ghana cedis. In fact, which was slightly higher than the budgetary provision for capital expenditure or capex. This is what we have been doing. If you look at the narrative underlining all of that, you will see why. In fact, and if you talk to some people, they will say that it's far better to be a CEO of some of these state-owned enterprises or a senior person in those organizations than actually being a sector minister, right? Okay. Because of the reward mechanism that goes with some of those offices and the less monitoring by citizens and the media, because sometimes the satellite is on the executive, the ministers, and the rest of them, whilst they pass around with all kinds of expenditure and travels, which ultimately is loaded on the pocket of the taxpayer. That's one level. The other thing to also look at, Winston, is to look at some of these state-owned enterprises and see the rise in their administrative cost over a period. And then you can compare that to similar companies in the private sector along those same lines, and you see inefficiency. Even though the SIGA report is telling us that in terms of operational efficiency, there have been gains and all of that. If you do sector comparison, where there are relevant sectors, you will see that there is inefficiency that is passed on to the taxpayer ultimately. Remember that we talk about these losses in the books of these state-owned enterprises. Ultimately, the state will have to come in and bail them out or subsidize them or to keep them afloat. It comes down to higher taxes or levies, okay, which Parliament would approve and it will be imposed on us, like the one that was done recently.
Okay.
Those are the things. First, I'll give you one example. Hello?
Okay. Yes, we're listening. Just give me that one example so that I can get to Yaw Lartey.
Yes, and then, yes. So in 2008, for instance, if you look at the National Health Insurance Scheme, they spent 86%, this is data for Ministry of Finance, they spent 86% of the total allocation to them on paying claims. That presupposes that we are talking about probably 14% on administrative costs and all of that. Fast forward, 2024, just about 56% was spent on claims. That implies that approximately 44% goes to administrative costs. So administrative costs has risen from 14% 2008 to 48% and all of that. In fact, if you do the trend analysis for a lot of the state-owned enterprises, you see this running across. What it also means is that even some of those state-owned enterprises that are doing well, with better oversight and higher efficiency and monitoring, the state could gain more from them than what they are doing currently.
All right.
Some too are just used to making losses. Here I'll talk about ECG. And in fact, if you look at the data from 2021, 2022, 2023, and you add 2024 to it, you can see the losses as predictable as it could get. The other thing to also note is that not all state-owned enterprises did submit their annual reports.
Yes.
Not all of them. And I think that is another area we need to highlight.
Please hold on 1 minute for me.
You only submitted management report, and I think that is not good enough. And it cannot be relied upon, really. And some having been audited, of course, in terms of signing off because of the transition, we can understand that some having been audited at all, some have just submitted management reports, and all of that. We need to understand why that and what will be the implications for the non-submission and all of that. The other bit also to look at, Winston, before Lartey comes in.
Sure.
As a country, if you look at the reforms in the management of state-owned enterprises, they have not come from we ourselves. They have come more from IMF, World Bank-led reforms. So we ourselves, we are not doing anything. If it's not support from the World Bank or the IMF or other external bodies, we ourselves are not investing in improving the efficiency of our state-owned enterprise. It's so amazing. A country like Ghana, if we don't rely on foreign aid support in reforms, nothing gets done. Even basic studies, analysis, which can improve efficiency, we have to, unless the support comes from outside. I think after 68 years of independence, really, are we serious?
Great. Let me bring in Yaw Lartey. Yaw, so you've been going through the report as well. What's your take on the performance of these state-owned enterprises?
Yeah, so I think as Prof said, so good morning to you, Prof, and to your listeners as well. So if you look at the report, it gives you a sense of where we are having some challenges at the operational level and then also at management level. So the government of Ghana or the public sector performs very well in certain sectors than others. So on the revenue front, there's been significant growth in revenue of more than 20% in the entire public sector based on the report received. And the growth was largely driven by the energy and the financial services sector. But if you look at the report in detail, you realize that the energy sector is also the key driver of liabilities, increased liabilities and increased losses. And the key operators in the energy sector are VRA, ECG, and GMPC. And so the question you ask yourself is, whilst you are growing the top line, are we being efficient in managing the cost, the middle line, so as to save our profit? I think Prof mentioned earlier that there is mention of operational efficiency. But what the report mentions that operational efficiency is as a result of reported profit before interest and tax. Now, after you factored interest in the financial performance of these companies, a lot of them report losses. So the question you ask yourself is, how are these state institutions financing their activities? The cost of financing for them is relatively more expensive. And so that's what you see, that there's operational efficiency, but if you factor in finance costs, then they report losses. So what these state institutions should do to improve efficiency a lot better is to look at their financing sources. So historically, government has either provided some guarantees, government has supported with subsidies, particularly in the energy sector. We should move away from that and allow the energy sector and all the state institutions to operate on their own. And I say this because there are some state institutions, so the story is not all gloomy all through. There are some institutions that have involved consistent profit makers. And I'll mention the names of some of them. So We Power Authority, which is the energy sector, is doing well. Ghana Gas Company is doing well in the energy sector. Bulk Energy Storage and Transportation, BOS, is doing well. And these entities have had uninterrupted profitability over the period. So what are these entities doing to increase their profitability or increase operational efficiency? So one is some of what Prof mentioned, that operationally we encourage them, and there's some KPI sets to encourage their good performance. They also benchmark themselves against other operators in the sector. So I think overall, if you look at the report, some of the recommendations of what we need to do is for government to diversify its portfolio. If you look at the portfolio performance, government performs a lot well in the construction sector and the financial services sector. So if government is supposed to play or do business, they should support the portfolio in areas of financial services sector. Because financial services sector, Ghana Reinsurance, for instance, is one of the companies that pay dividends to government. So we should support and expand such businesses and enable them to grow so that at least we can pay dividends to government and employ more people. The construction sector, CDC, Ghana Housing Authority, etc., did very well. So the construction and real estate sector is also good business for government. Government has a lot of leverage in the sector. We should be emphasized and also look at some operational issues in the energy sector. I think that's the sector that carries a lot of liability for us. Also, we have some companies that have been consistent loss makers. I think what government should do is to consider some form of private sector participation or overall diversity of the sector. And it's just interesting to note that Ghana Cylinder Manufacturing Company, for instance, has consistently been posting losses, and it's recently been acquired by Ghana Gas Company, which is a good performing company. So the ones that are performing well are acquiring those that are underperforming. I think that's a good strategy. We should encourage companies that are performing well to acquire those in similar business that are underperforming, so that they can use that leverage they have as good or performing businesses to help and bring efficiency in the companies that are inefficient. And also, we have to look at overall improvement in the financial management sector and the public sector. We can't have a situation where only 50% of public sector institutions are able to present audited accounts. What that means is that 50% of public sector companies have not gone through the rigorous process of having gone through external audit. External audit will ensure improvement, will ensure that management are doing their work, and will also ensure that there's transparency. So the management reports that we are using today or that are being submitted today, they haven't gone through the rigorous process. So some of the figures that are reported, they need to be adjusted. Some of them may be understated on one hand, some may be overstated on some other hand. So if we don't improve our public financial management system and ensure that we are holding people accountable for their inability or failure to submit audited financial statements at the end of the financial year, then you continue with this vicious cycle of having inefficiency in the public sector, as Prof said. If you want to bring efficiency in the sector, we should hold people to certain KPIs. And one of the KPIs includes ensuring that people submit audited financial statements by a particular period. If you look at the financial service sector, banks are supposed to submit or publish their audited financial statements by the end of March. And you get sanctioned by the Bank of Ghana if you fail to do that. Same way we have to do instance where SIGA is sanctioning state institutions who fail to publish their financial statements, let's say 4 months after the end of the financial year. If you don't have those sanction regimes, people will continue to operate inefficiency that we are seeing. And I think overall, where these institutions that we are reporting, at the operational level, like I said, they are doing well. But if you factor their finance costs, then they go into losses. So we go into this institution to find out exactly where they are borrowing. I remember one of the days we are having a case where the contractors for roads, the amount at which they are borrowing and the rate of interest that is being charged them, some of them are so onerous and ridiculous. They are charged on daily basis. And for an entity that is getting into construction, you can't negotiate a finance regime with that kind of arrangement because construction takes a long time. So if you don't strategically negotiate where you are getting your money from and you do not put a cap on your finance cost, you have instances where these entities are reporting losses, not because they are operating inefficiently, but because their cost of borrowing is overly expensive. And I think it's something that they should review.
Exactly. Let me bring in Professor Bokpin briefly on the financing cost, because if you look at the report, it actually tells you that a lot of the challenges stems from the financing cost, the finance cost, for instance. If you look at, say, an entity like ECG, their earnings before interest and tax, Professor Bokpin, is actually 1.8 billion. However, their net profit, which is a loss, they make a loss of 8.2 billion. Help us understand where the challenge is coming from, Professor Bokpin.
Yes, thank you very much. As Yaw just mentioned, if you run the business, you are looking at your finance input costs, labor input costs, fiscal input costs. These days, we also talk about digital or technological input costs. And all of that. I think a good manager, you want to be able to ensure that your average cost of capital is as low as possible. And to the extent that other businesses would probably slightly worse balance sheet than some of these companies may be obtaining financing at lower cost overall compared to these state-owned enterprises, already tells you we are not doing quite well in all of that. And also in terms of exploring alternatives, in terms of financing, sometimes the incentive is just that we are state-owned enterprises. We can take the money at any cost. The state will come in. If you were managing your own business, you will be very mindful because it's the same economy. It's the same financial system within which other businesses are obtaining credit and all of that. If you understand why the risk is high, for which finance cost sometimes goes high, it comes down to some of the inefficiencies on their own balance sheet, which doesn't make it that attractive in getting lower financing costs. And those are the things that we want to look at. And then the role of government itself in all of this, more or less also as backstopping it, even though we are not using that leverage to get lower cost of financing. Let me give you an example. Appiah mentioned construction. Winston, do you know that the total budgetary allocation 2025 to CAPEX, capital expenditure, just a little above 33 billion Ghana SOEs, actually, at the end of the day, it will not end up in constructing a fresh kilometer of road. It will not. Do you know why? It's simply that allocation may not even be enough to cover cost overruns in the construction sector alone in terms of existing contracts that have been awarded. You heard the Minister of Finance saying that just with the transition, many of these contractors have submitted increased costs based on the existing or same kilometer of road and all of that, for which reason the Auditor General has been asked to come in and audit and verify and all of that. Sometimes because of the delay in the payment of contracts and all of that, these firms construction companies actually increase, mark it up to protect them from those delays, and all of that also result in a higher cost. You see that also in the finance arrangement in the sector. So I think it comes down to we being diligent in lowering our cost of capital, and we ensuring that our IGF is managed prudently, because some of them may be taking finance costs or external financing when they have liquidity in their account with other financial institutions, simply because of some arrangement they've entered into with some of the banks that allow some kind of interest payment and all of that. Deals, right? What we call deals largely in the market. Okay, so it's about optimizing your operation and making sure that you lower your cost. But overall, if you account for the finance cost and all of that, it is not good. They are not the only one operating in Ghana. The interest rate regime is not peculiar to only the state-owned enterprises. Other businesses in similar lines, in fact, with less competitive advantage, are able to manage within this same economy than some of them are doing. Okay. If you look at the performance over the period, even Gridco, they have not been consistent with making profit over the years. If you look at the data from 2021, 2022, 2023, and some of them too, you see that because of the sheer size, their size in the market, like ECG, if they are inefficient and that inefficiency results ultimately in losses, their losses tends to be very huge, and therefore it dwarfs the overall net position of state-owned enterprises. So we need to look at the big tickets where we think that we can restructure and they can actually make profit and pay dividend to the state. And an example is ECG. And I always say that ECG will make or break this country.
Hold on for me on that point.
Their inefficiency is so huge.
Prof, hold on for me on that point, where you say ECG will make or break this country because their inefficiencies are so huge. When we return, we'll get to understand why you think ECG will make or break this country. We need to go for a short break. But I would also understand, you make a point about, cost of capital, for instance. How come that some state institutions with good cash flow have become so risky that their interest rates are higher than those that are, don't have the kind of books they even have? We need to understand the deals that you say go on there and how we can correct them. So before we went for the break, Professor Bokpin, you said that ECG could make or break Ghana because of what? Inefficiencies. Tell us more about that, Professor Bokpin. Hello, Professor Bokpin. Do we still have Professor Bokpin on the line?
Yes, I'm on the line.
Yes, please. Yes, please go ahead.
Nothing can happen in this country without energy. That's how fundamental it is. We currently don't have enough power even for an 8-hour economy, so to speak. We are talking about scaling up to 24-hour economy. Even if you don't want to proxy the 24-hour economy by 3 shifts of 8 hours, and you want to say that you are calibrating all the sectors of the economy to operate fully, industrialization is heavily reliant on energy. Not just energy, but cheap and reliable energy that makes our private sector competitive. Not only private sector, but the public sector overall. Because remember, an inefficient public sector represents cost to the private sector as they interact with the public sector. So without addressing the energy sector and the needed transformation, I think we can't be talking about 24-hour economy or economic transformation, or even if you look at it from structural transformation or productivity transformation, it's as simple as that. But let's look at the more fundamental things. If you look at current level, ECG's revenue collection is at 85%, while the world average, global average is 98%. When it comes to losses, ECG's losses is as high as 28%, while the global benchmark is between 10 and 15%.
Okay.
If you look at across all the indicators, there isn't much that gives you hope without drastic reforms. And we are not seeing those reforms. Even under this new regime, we are not seeing those structural drastic reforms that will transform the sector. We are not seeing that. It's coming down to business as usual. And you can understand why it will come down to that. Largely because of governance and management malice, which you can trace to excessive interference by influential individuals in this country, which creates the kind of managerial incompetence and laxity that we see in there. Beyond that, procurement abuse. You review the ECG report, you will see where ECG has over-invested in some areas and under-invested in other critical areas where they have had to contend with idle inventory for many years, months, while there are deficits in other areas. Those idle investments represent locked up funds that could be recycled into other critical areas of ECG. And the reason you have this idle investment or over-investment is because of the procurement economy that we have created within some of these state-owned enterprises that benefit powerful people in this country, politically exposed. Let's put it that way. And we see these reports day in, day out, but nothing gets done. No arrest, no prosecution, no recovery. The next moment you hear is to introduce levies and pass on those inefficiencies to the ultimate taxpayer or the consumer. I mean, you can't develop. Look, if you look at it from now to 2029, the budgetary provision that we have to make to cater for the inefficiencies of ECG alone, Winston, is actually more than the annual budgetary allocation to the Ministry of Food and Agri, Trade, Health, Education, all of them. In fact, the priority sectors of this economy, if you look at their annual budgetary allocation and you put everything together, it's not up to the energy sector inefficiency we have to cover up through the same budget annually. So without improving the efficiency within ECG alone or the energy sector alone, there is no way we can allocate appropriately to the critical sectors of this economy in the area of agriculture, health, education, or even if you talk about social spending, if you define that to include spending on education, health, and social protection, you add agri, you add industry. So you can check over the period. In fact, from 2022, if you look at the energy sector shortfall that we have to make budgetary provision for, and you compare that to allocation to all the priority sectors of this economy, it drags it.
Okay.
So the question is, how do you scale up? And without, look, Wilson, this is not a joke. Without spending appropriately in the area of food security, we are not going to get the result. Without spending appropriately in fact, if you look at Ghana's health expenditure per GDP on our population, it's one of the lowest in West Africa.
Okay.
If you look at budgetary allocation to Ministry of Food and Agri, health, education, all the priority areas, and you compare that the inefficiency coming from the energy sector alone, wow, it's amazing. You can never discern a future from this. This is not like we don't like Ghana. So let's tickle ourselves that we want to develop. But without addressing this inefficiency from the state-owned enterprises, we will not make the progress. But before I continue to the other thing, there was something Yaw mentioned, which is very important, right?
Okay.
The state should consider reducing its interest in some of these state-owned enterprises. If you look at the same report from SIGA, you realize that joint ventures where the state has far less holding, they are a bit more profitable compared to joint ventures where the state has higher interest.
Exactly.
Okay, and then compared to a state-owned enterprise where the state is the sole shareholder. So across, so you can see that the problem may be more from the state being a majority shareholder and not using that to drive efficiency, compared to the other state-owned enterprise or joint ventures or other entities where the state has far less interest or in terms of shareholding in those areas. So if you look at it from the ownership perspective, you can see that the state is not using its majority holding to drive efficiency, and we should be looking at how we can address that without compromising national security or sensitive activities. And I think we should export, and I agree with Yaw Appiah Lartey. Oh, listen, do you remember the current IMF supported program? There is supposed to be a structural reform benchmark linked to private sector participation within ECG. Do you remember that?
Yes, I do.
In fact, we are supposed to check a certain box by the end of September or October or so. So we should be looking at government should be both. I think there should be.
So please hold on for me. Yes, please hold on for me, Prof. Please hold on, Prof. I need to get to Yaw because, I mean, you review these things. You review transaction agreements here and there. You look at financing cost and all of that. I'd want to understand why state-owned entities, some with very good cash flow, good books, but have become riskier than those that are not even in the kind of position that they are.
Yeah. So.
Yes, go ahead. Yeah.
Okay, excellent. So I think there's a background to it, particularly on the cost of finance, the elephant in the room.
Yeah.
If you look at this report, the cost of finance, like especially the elephant in the room, that's what is affecting a lot of state-owned institutions. And the key reason for that is there's a background you have to put in context. So when Ghana moved to become a lower middle income, we did not get or we were not having access to concessionary loans. So historically, you see that government used to borrow and give them out as loans to state-owned institutions. So what the government will get a concessionary facility and on-lend to institutions. When you move to the lower middle income sector, those concessionary facilities cease. So a lot of states are not getting support from government through those on-lending activities. The second issue is that generally the macroeconomic conditions worsened when we were downgraded and then we lost access to the international capital market. Borrowing in Ghana became expensive, not only for public sector, but even for the private sector, because the country risk, what we call the sovereign risk, has become very high. And when the sovereign risk is very high, you realize that entities that live in the country or that operate in the country also have higher risk. And so entities, whether state institutions or private sector, were borrowing at relatively higher rates. And so these are the factors, obviously, some of the macroeconomic factors that affected state institutions. So yes, without knowing what it is for these managers of these institutions, there are some macroeconomic factors that affected their business. But I think going forward, what this should do or consider to do is that you don't just walk to any institution and say you need a facility to do a fancy program or to build a new facility, etc. You have to go through a competitive finance process. So elsewhere in other African countries, if ECG wants to borrow, Ghana Water wants to borrow, they send out a request for offers from various institutions. And it's not only local, there's an international competitive process where even international development finance institutions are participating in the process, the African Development Bank, Africa, etc. So when the offers are brought to you, you appoint a third-party institution who is independent of these institutions. The challenge is that some of these institutions have their advisors or have their investment bank. So you have an international bank that has an investment bank, and the investment bankers are the ones that end up advising these institutions. They are not independent, and you may not get a competitive offer. So state institutions should consider competitive process of raising finance. If you don't go to a competitive process of raising finance, you may not get a competitive offer or cheaper financing source. The second, the other issue that we should also do now, not only for public sector, but even for private sector operators, businesses that are listening to us, this is a very good time to refinance the state facilities. We're in the interest rate regime that were over 60%. Now lending rates are dropping. What it means is that you can borrow at a cheaper rate to pay off state facilities that are running at a higher rate. So state institutions should go to the point of refinancing facilities, and closely linked to refinancing facilities, that we should move away from facilities that are dollar linked. A lot of these institutions go for dollar facilities without adequate hedging instruments. Sure. So if you are going for a dollar facility, you have a hedging instrument to absorb you from any risk of exchange rate fluctuation. So if you go for dollar facilities, you have a hedging instrument. If you don't have a hedging instrument, then you go for a local or state-denominated facility. So So this is a good time for state institutions to review their finance costs, they finance existing facilities that are operating at a higher interest rate regime. And I guess the last is also where we have historically been supporting some of the state institutions with subsidies and all. We should just stop that and allow them to run efficiently, independently on their own. And I guess what we can also use support at the management level is proper incentive packages. There should be incentive packages that are linked to performance. So elsewhere in other African countries, there are incentive packages that are developed for public sector, and it is public. So if you are performing or you are head of any of these state institutions, at the end of the financial year, you know you are not getting bonus. One, because you don't submit your financial year. Two, you reported a loss. And so you are not getting any bonus, nobody is getting it. If it's public and you have transparent process of incentive packages, you will have some of these state institutions performing or looking to perform better. Over and above that, we should also look at broadly how we get to increase performance in the public sector. You mentioned state institutions that have been constantly posting losses, and maybe for the benefit of those who may not have read, the Ghana Cylinder Manufacturing Company, Ghana Water Company, Graphic Communication Group, and Thermal Oil Refining are named here as underperforming companies. Now, what can we do about these institutions? There's something we call private sector participation, PSC. It is not a sale of this entity, neither are they privatization of state institutions. You can have some form of private sector participation. In South Africa, they develop what we call the Water Partnership Office, WPO, and the head of the WPO sits in the Development Bank Ghana equivalent in South Africa. So they sit in the Development Bank of South Africa office. And what they do is that they structured various water projects. So the Wager water project can be structured as a facility where a private sector comes in, operates it efficiently, and shares revenue with government. And the rationale behind this is that you want, as a country, to be shareholders, 10% shareholders in a $100 billion business than to be 100% shareholders in $1 million business.
Okay.
If you're 100% shareholder in a $1 million business, you only have $1 million. But if you are 10% shareholder in a $100 billion business, you have $10 billion. And so if you don't operate to this principle, and we say that we will not allow the private sector to operate or to support the public sector, the efficiency that you are looking to get, you may not get. Graphic Communication Group, for instance, historically was one of the well-run and good performing business, and we're seeing this in government. So what happened? So it means that there are instances where we need to review their management style, the operation, set some KPIs, also support them to expand and grow. We are in an era where a lot of things have been digitalized, the media space. And so for Graphic Communication Group to be able to compete with the media in the private sector, especially with even international firms, they need to be supported to expand and grow their business. If they are supported and expand and grow their business and become modernized for this, they'll be able to perform well. And then we have issues like entities like Thermal Oil Refining. I think Thermal Oil Refining issue has gone back and forth for so many years. We have to put Thermal Oil Refining in different categories and have a proper assessment of what you want to do with and decide and take it. Because we are building refineries, and yes, we have an age-old refinery that has been sitting there for so many years, been operating and reporting losses, and we can't be proud of it because we have that refineries operating in Africa that are operating profitably. And so what are these countries getting right and what are you getting wrong? It's something that you should look at.
All right.
And then lastly, at the management and board level, we should not just appoint board members because let's say there's a change of regime or they are based on people we know, etc. The board and management that should appoint for these state institutions should be diversified. Should have people who have the relevant experience, because if you are appointed to head any sector, let's say the energy sector, it's a complex sector. You are negotiating facilities, gas sales agreements that are written by international firms like Norton Rose. And so you can't have someone who is sitting on a board and probably can't get the sense of some of these agreements because you are negotiating international transactions. And so some of the board members should have the relevant experience, should have the right exposure. It helps to increase the efficiency of these institutions. And there are state institutions that have very good board members that are running the entity efficiency. And so this report is a very good step for us to look at the future, look at those who are doing well, learn from them, and improve what we have been doing over the years.
Thank you very much, Yaw Appiah Lartey. Let me say thank you, Professor Bokpin, also. But the conversation will definitely continue. Yes, Prof.
Prof,
just
please.
a quick one. Remember that in this country, some state-owned enterprises were borrowing at far lower cost compared to Ghana government before.
Yes.
An example was COCOBOD before. So some of these state-owned enterprises could be restructured and have a better balance sheet than Ghana government. It's inefficiency, it's corruption, it's greed. This is what has brought us here, and we are on that path.
Thank you very, very much, Professor Godfred Bokpin.